Now, if you want to see how the bank is overcharging you for 88 years, the banking industry has been providing mortgages and other loans using an amortization formula that's been overcharging us by 75%. I've got in Brett Whistle a $200,000 mortgage at 3% interest, and I'm clicking on the little box to show amortization schedule. All right. And the payment is $843.21, which is way less than you would pay in rent on the same size house or apartment. So that's how we get drawn in, folks. You know, we've heard it before. Why pay rent when you can own? Well, you're not really owning until the loan is completely paid off. You are buying, though. So we're turning renters into home buyers. And every time you have a home buyer, okay, you're actually renting the money for a time. So you go from renting in a house to renting money. So we're going to talk about how the bank is teaching us and conditioning us to rent money for our entire lives, while in our back of our mind, we're calling ourselves homeowners. Here we go. All right, folks. So here's what we've got. I got $200,000 at 3%. First of all, we're going to find out that at 3%, the total interest paid on this loan for 30 years is $103,555. Folks, how in the world is that 3%? I'm going to show you how the bank turns 3% into 51% return on their investment. They are investing, and we're the natural resource that they're tapping. You know, when you dig down and you find oil or you find gold or you're mining for diamonds, whatever precious resource you are mining for, it comes up dirty. It comes up mixed with other stuff, and you can't use it right away. You know, diamonds coming out of the ground, they look like white rocks. They're not polished. They're not anything. The facets aren't cut in them. They don't come out of the ground looking like they're in your ring right now. They're messed up. They're ugly. So what you do is you take it out and you refine it. So what the banks have done is says, listen, we don't make anything. We don't produce anything. We don't manufacture anything. What do we do as bankers that run the whole country? Because nothing operates, nothing runs without money, and the banks have the money. So they're at the top of the food chain. The banks are at the top of the food chain. And so if they don't produce anything, if they don't make anything, if they don't manufacture anything, what are they doing? They have to mine natural resources and then get the natural resources to produce an income for them. So what do? They have money and they lend it out, and then we pay them interest. So how do they do that? They say, well, how can I squeeze every drop out of my natural resource? I need to lend them money for as long as I can, for as much as I can, and let them believe they are being efficient in this money's use. They believe that they're doing a good thing, while at the same time, we as bankers are making trillions upon trillions and nobody even realizes it. How do we do that? Okay, here's what we're going to do. And I'm going to put my calculator on the screen so that you can see it as well. Okay, so we're going to clear this out. Here's what we've got. First of all, the bank wants to charge us $103,550.60 on a $200,000 loan. $103,000 on $200,000. How is that 3% when in fact you can see that it's over half? In fact, it's 51.778%. How does the bank get to charge us? Watch this. $200,000 at 3%, which is, I wish I had a 3%, but we're not looking at the total interest cost, which would be 103,555, which turns into 51%. How do the banks do that? Think we have a good interest rate at 3, turn it into 51%, and we think we've got a good thing going here. So let's take a look at this loan. When you make your very first payment of $843.21, $343 of that goes to principal and $500 goes to interest. So when you pay your $343.21 to principal, you're left with a principal balance on line one, $199,656.79. Now, I did this a different way, but Credit Goddess showed me another way to figure this out. I'm going to let her take you through how all of this works.
So let's go to line 2 since we already made the first payment. So the way this works, in what Don was saying, how, even though you were charged 3.5%,
3%.
3%. Okay. So a lot of people are looking for lower interest rate, but lower interest rate would cost you a lot more than a higher interest rate. How? Because you're being charged 3% on the remaining balance that you have left. Okay, so let's do these numbers. Let's work with these numbers here. $199,656.79. You're going to be charged 3% of this remaining balance. And this happens every single month. So every time you make your initial payment every month, they take their money out first, and whatever that's left goes towards the principal. So let's do the math. $199,656.79. Let's type that in a calculator.
$199,656.79. I got it.
All right. So let's write out this formula because they're probably like, what are you doing? Mm-hmm. So the formula is you take the total balance and then you multiply it by 3%. And the number that it's going to give you is going to be the APR for the year. Okay, so then we're going to take the APR because we're going to want to know how much we're paying in interest for the month. So we're going to take the annual APR, and then we're going to divide it into 12. And then whatever that number is going to be what the interest cost is. Then we're going to subtract the interest cost from your monthly payment. And whatever that's left is going to be the amount that's going to go towards the principal balance. So okay, let's multiply that by 3%.
199,000. 656.79. All right. And multiply that by 0.03.
Yes.
By 0.03 equals $5,989.70.
All right. So that is for the year. Mm-hmm. So let's divide that into 12.
We're going to divide that by 12 equals $499.14.
Do you see that on the second line?
What? So they're taking 3% of the unpaid balance every month, not 3% of what I borrowed, which is $200,000, because 3% of $200,000 is way less than the $103,000 that they want.
Right.
So what I'm seeing here is that I'm paying 3% every single month for 360 months. So it's not one mortgage, it's 360 separate mortgages.
Yes.
No wonder it is so much. Folks, what do y'all think about that? What do y'all think about that?
All right, so we're going to finish the equation. So that's $499.14. You see it right there, right?
Yes.
So we're going to subtract the $499.14 from the monthly payment.
Okay.
What's the monthly payment?
The monthly payment is $843.21.
Oh, $843?
Yep.
Okay, so let's type in the calculator, $843.
Okay, $843. Okay, $843.21.
Mm-hmm.
All right, minus $499.14 equals $344.07, which is my principal payment.
Yes.
So out of all of that money that I'm paying, only $344.07 goes to principal. And
yes,
every month, I'm paying 3% on the unpaid balance.
Yes.
So is there anybody out there that was made clear to you when you got your mortgage, or were you thinking that low 3% meant that you're going to pay 3% on the $200,000 that you borrowed? Come on, folks.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.